On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi there, everybody. Just a quick one today. I say that quite often, don't I? Then I ramble on for 20 or 25 minutes, but I do mean it today. Look, it's August, which is Money Month. It used to be Money Week, but now they do Money Month. The old Retirement Commission runs this every year, and it's sort of an annual public awareness campaign, really designed to just get people talking about money, with a view to helping people understand money, improve their financial well-being. Financial literacy isn't fantastic in New Zealand. We can definitely do better. So it's a great initiative just to give us an excuse to talk about some of the things we should probably be talking about more regularly anyway. But in the spirit of Money Month, I thought I would just let aspiring share investors, there's more people investing in shares these days than we've seen in a long time, which is fantastic. Great to see. And a lot of people are for the first time learning about the share market. So for all of you, I thought I would let you in on a secret. And the secret is it's actually much easier than people think. It's not rocket science. And if you follow a few pretty straightforward common sense rules, it's actually quite hard to go wrong, and you're highly likely to do well on your share investing journey. So I've just singled out two of those simple rules. Otherwise, we'll definitely be here all day. But the two that I want to talk about today is one, you've got to be well diversified, and the second one, and probably one of the more important, is you've got to focus on the long term without letting the present day, the issues that are going on at any point in time, sort of push you off course. So those are the two things I think are really important for share investors to make sure they're doing. And the first bit is pretty easy. Any advisor that's worth their salt will preach the diversification gospel. So that's something we all talk about all the time. Don't put your eggs in one basket. Make sure you spread your risk. Be well diversified. And that means owning a range of different companies rather than just sort of picking two or three or even 10 that you love. You've got to have a spread of different companies. You should have those spread across different markets and different sectors and industries. There's no point saying, well, I'm pretty well diversified. I've got 20 companies in my portfolio and they're all in the tech sector in America. That's not diversification. So diversification means diversifying across the different regions of the world, not just New Zealand, not just the US, but, some emerging markets, some Japanese shares, some UK shares, European shares, whatever, and spreading across different industries as well. So you've got to do all of those things. It's pretty easy these days, with ETFs and index funds, anyone, even with small amounts of money, even if you're drip feeding into a savings plan of some sort. We've had a fractional investing offering since the 1990s, and I know there's other companies that have sort of jumped on that bandwagon much more recently. But even if you've been putting $50, $100 a month into a sort of Craig's fractional investing plan for however long, you can easily sort of still be well diversified because you just use those index funds or other funds or ETFs to sort of hedge your bets and get that spread Obviously, if you've got more capital, you have the luxury of being a little bit more sophisticated about how you do things. And most clients of ours, even the very large ones, will still use some index funds and some ETFs and some other types of funds, investment trusts or whatever. But they will also invest in direct shares, and that allows you to sort of tailor a portfolio much more specifically to your needs. So if you have got sort of direct shares in your portfolio and you've got a range of funds and ETFs, you can much more easily sort of dial up the income generation. If you want more income, you can target parts of the market that either offer better growth, better value. You can align a portfolio much more easily with your sustainability goals. So that's why it does make a lot of sense to work with an advisor and have something that's specific to you. If you're just in the sort of ABC managed fund or the ABC ETF, then you sort of what you get is what you get, and you haven't really got any ability to make your portfolio reflect your needs and goals and other sorts of things that you're trying to achieve. But the point is, whether you're big or whether you're small, these days it's pretty easy to diversify your risk, and that's really what you're trying to do. You're trying to spread your risk, cover your bases, and not be too concentrated. So if you look at how markets have performed in the last few years, then it's pretty easy to see why you would do that. And just look at last year in the US market, the energy sector surged. It was up sort of 50 or 60%, because of inflation. The energy sector is often a sector that does well during periods of high inflation. That's a story for another day why that's the case. But energy sector really strong. And then you had the tech sector that slumped nearly 30% last year. Then this year, that's really been turned on its head. Tech stocks have rebounded strongly, almost 50% up, and energy has been one of the weaker sectors. The energy sector's been down a little bit. So the answer is not, well, you should have been all in the energy sector last year and then at the start of this year sort of switched and gone from energy into tech. If you're good enough to do that, if you know what's going to be next year's winners and losers and the year after and the year after, go for your life. But most of us don't have a crystal ball that works quite that well. So I think for most of us, it's much more sensible to have a little bit of everything. You don't want to be sort of all in one of these parts of the market or even regions of the market, because if that asset class or sector or industry part of the share market doesn't do so well, then you sort of find yourself falling behind. And it's much safer and more sensible to just play it safe and have a bit of everything. So pretty common sense, be well diversified. It's easier to hedge your bets, and you'll get a return that is closer to sort of what the typical market index is offering, which isn't a bad thing. We'd all like to outperform, and if you're working with a good advisor and sort of making some sensible tilts, then you can do that. But you also want to make sure that you aren't sort of biting off more than you can chew and taking on too much risk with a portfolio that's too concentrated. So be well diversified, pretty common sense. The second piece of advice is a lot harder to follow. Keeping your eye on the long game. That is much more difficult than it sounds, especially when you've got periods of uncertainty, which come pretty frequently. To be honest, I think about my time in the industry, which is sort of 20 odd years. There's always something to worry about. Whether markets are strong, whether they're going up, whether they're going down, whether they're going sideways, whether we're in a recession, whether we're in a buoyant period. There's always a long list of things to worry about. So you'll never find a time when it feels easy and safe. We're either worrying about sort of recession or rising interest rates or high inflation or some geopolitical issue. We're either worrying about all of those things, and if you haven't got those things to worry about, you're probably worried about sort of high valuations and the market being too expensive, and am I sort of investing right at the top? So there's always something, and that is just part and parcel. However, we've got to put those things to one side and focus on 5 years ahead, 10 years ahead. And if you don't feel like you can stick it out for that sort of time frame, I'd say minimum 5, but ideally 10 years. If that's not the sort of time frame that you're thinking in, then to be honest, the share market isn't the right place for your money. If you're thinking sort of 2 years, 3 years ahead, you probably should be in something more conservative. Money in the bank, bonds, fixed income, because the share market, like owning a business, like owning a farm, like owning a property, it is very much a long-term asset. You'll do very well in the long term, but in the short term, things can be all over the shop. And the share market is almost more so than others in that regard. It's kind of weird. Financial markets are funny. The further ahead that you look, um, the more predictable things become, which is a little bit different to most things in life, which is why it's something that many of us grapple with and sort of struggle to get our heads around. Usually in life we have a lot of visibility about what's going to happen in the short term. What we're doing today or next week or the next 12 months. We kind of know that. Looking ahead 3 years, 5 years, 10 years. Who knows? But the share market is almost the opposite. It's impossible to say what's going to happen over the next week or month or even year. But if you look ahead 5 years, 10 years, certainly beyond that, the market actually becomes quite predictable. So it's not something that our brains can sort of get their head around, but we have to if we want to succeed. I looked at the US share market back to 1945. So I picked 1945 because that's sort of the post World War II period. That's 80 odd years almost. So it's a reasonable sample. And going back to 1945, the annual return from US shares, including reinvesting your dividends, so it's share price change and the dividends you've got, and you're reinvesting those dividends back in. The annual return has been 11.2% per annum, which is fantastic. Actually, that's a great return over those 78 years, and most of the time the market's been up. So if you look at the calendar years from 1945 through to the end of last year, 2022. This year's sort of heading for another up year as well at the moment. But in those 78 years, US shares were up in 60 of them. So not a bad hit rate, is it? 60 years out of 78, the market was up. So I think that's a little more than a 75% hit rate. So good return over the long term, 11.2%. Solid hit rate over nearly 80 years. 75 knocking on the door at 80% up. However, in the short term, the variation can be significant. So in that 78 years, I looked at all of the 12-month periods, split it up into sort of 12-month blocks, and there are a lot of them. So we're not talking calendar years, we're talking just 12-month blocks in their entirety. And the biggest gain in a 12-month period was a rise of 60%, 60. That came in 1983. So massive gain. And the biggest decline was a fall of 43%, which was sort of in that post GFC period, or in the thick of the GFC really, through 08, 09, somewhere in there. So I guess my point is that while returns are fantastic and quite predictable over the long term, over the short term, it's very much scattergun. You get times when the market will be flying, like it was in that one example in 1983, and there's been plenty of other times as well, up 60% in a year. And you'll get other times where the market just gets absolutely belted, like it did in 08, 09, down 43% in a 12-month period. And that sounds quite scary. That's quite off-putting. Geez, why would we invest in, this share market stuff when you can get such massive gains, but also such massive losses? It sounds really sort of volatile and risky. And I guess it is in a short-term sense, but if you group all of those holding periods into 10-year blocks rather than 12 months, because we should be investing with a 10-year mindset. We're business owners as share market investors. If you look at all the 10-year holding periods, then things look a lot less scary. The proportion of positive returns jumps to about 97%. So 97% of the time, the market was up sort of point to point. And the range of the best and worst per annum performances narrows a lot as well. Instead of sort of plus 60, minus 45, you're talking about plus 20, minus 3. So things get a lot less volatile, and your likelihood of having a positive experience jumps dramatically if you're sort of going to maintain that sort of longer term view. And if you move to rolling 15 or 20-year periods, which is a long time, but it's not unreasonable. If you're a 25 or 30-year-old starting to invest in shares, then that's well sort of within your working life. And even if you're a 50-year-old sort of thinking about putting together a portfolio or looking at the share market for the first time, 10 years, 20 years, you might still be working through that period, and you certainly will have plenty of years ahead of you where you need your money working hard and growing. So it's actually a realistic time frame. But anyway, if you move from that sort of 10-year block to 15 or 20, things look even better. You'll have, historically at least, US shares have delivered positive returns 100% of the time, through that time frame. And on a 20-year period, at least, the best per annum return over a 20-year period is about 18%, and the lowest is about plus 5%. So the longer you look, the more predictable the market becomes, and the range of potential outcomes narrows dramatically, and your chance of doing well increases to a point where we've actually never seen a period where you won't do reasonably well. So that's the thing with shares, like super hard to predict where they'll go over the short term, but as your investment time horizon and the holding period becomes more grown up and more long term, which it should be, because that's sort of the nature of the asset class, then it becomes much easier to have a good experience and to be successful. And it's not dissimilar here in New Zealand. You can't get the data going back, well, I can't, at least, going back quite as far as you can in the US. In the US, you can get data going back 150 odd years if you want to. In New Zealand, I don't have share market data going quite back as far as that. What I've got sort of goes back to the 1960s, but still, even in New Zealand, there's never been a 10-year holding period where the market has been down point to point. So even if you bought at the end of 1986, right at the top before the 87 crash, you've still got a positive return over 10 years, only just, but positive is positive. And even if you bought right at the top of the GFC in, late 2007, you've still got a positive return there as well. So over the long term, the market becomes a lot less volatile and a lot more predictable. And to be honest, that's the real secret to share investing. It's actually not rocket science. If you stay well diversified and you maintain a sensible time horizon, 5 years minimum, but ideally longer, then your chances of success are actually incredibly high, because while markets are impossible to predict over days, months, years, the returns you'll get and the volatility that you'll need to tolerate to achieve those good returns, they become much friendlier, and things become tilted much more in your favor the longer that you'll stick around. So a good share portfolio, well constructed, with good quality assets, well diversified, it'll just about always perform really well over the long term. The tricky bit is that we've got to stay the course, and we've got to keep that in mind when there's so many things to worry about in the here and now, and that's almost always the case. So look, it is simple. Those are very simple rules to follow, but they're not easy to follow. So it's one thing to sort of say or even know that sort of makes sense, but it's another to sort of live that and keep you cool when you're amongst a difficult, challenging market. But look, to be honest, if you can do that and get some help from a good advisor who will be able to sort of remind you of these things and keep you on track and help you sort of stay the course. If you can do that, then it's a recipe for success, and you will make this whole share investing gig look pretty easy. All right, that's all for today. Thanks, team.
For more insights, visit craigsip.com.